Right. So as the Bank of Canada announces its next rate decision at 10 a.m. Eastern today, we're awaiting that. We're going to take a closer look at the impact of tight monetary policy on consumer behavior. Let's bring in Dominique Lapointe, a global macro strategist for Manulife Investment Management. Dominique, thanks very much indeed for joining us.
Good morning, Andrew.
So are we seeing Canadian consumers react to these higher interest rates? Because we mentioned earlier, CIBC says higher savings rates are a sign that people are changing their behavior.
Yeah, there's that for sure. We've seen a little bit of a higher savings rate. But what we also noticed over the past 4 months is a small, but still a consistent decline in the volume of retail sales that was reported by Statistics Canada. Is that not something that we observe in the US? So we do see a slight pullback from the consumer. And at the same time, when you look at the categories of good over which we see this pullback, it's pretty broad-based. And so what we notice is that slowly but surely, we think that Canadians are getting more prudent about their savings, and that's maybe tied to maybe a dimmer prospects for the labor market.
You have a graph for us of Canadian household consumption based on real retail trade. And I guess by that, as you say, volumes are measured. It tries to factor out the higher price of goods.
Yes, and usually a good predictor of overall goods consumption calculated by the GDP can be measured with retail sales. And that's why we anticipate that in the third quarter, when we were going to get that GDP report, we'll see that consumer actually pulled back. And that might be just the beginning of a couple of quarters where Canadians increasingly have to pull back on their consumption because, as you mentioned, the effect of interest rates on consumption has only begun.
I guess it's widespread, isn't it? Higher mortgage rates leave people with less money in their pocket, and it's also harder to finance things like cars or durable goods.
There's a lot of dynamics at play. You've mentioned mortgage costs. I think that's something we'll see a little more next year as we have more people with fixed rate, for instance, having to refinance. But yes, for cars, definitely. Also the fact that there's a little bit of a pent-up demand for cars. And meanwhile, where we expect to see more weakness just from regular items such as clothing, electronic and appliances, anything that was over-consumed during the pandemic, we still think that there's some room for just some normalization that would, that in the end would lower overall consumption.
How do you, as you're looking at, let's say, today's interest rate decision and maybe over the longer term, let's say over the next 2 to 3 years, how do you see interest rates playing out? Do you think this is the normal level of rates we're going to have, or is it just that now that we're at the 5% range, this is going to have a significant impact on the economy? We're just in the early days, and we should see rates to go back to a different level for normalized. What are your thoughts on that?
It's an interesting question. I think that because of the supply side issues that we face after the pandemic and still some supply side dynamics at play over the long run that could keep inflation on a marginal upward pressure relative to what we had in the prior decade, that would equal somewhat of a higher rate over which we're going to be normalizing starting next year. That being said, is 5% or 5.5% sustainable? And I think what we're beginning to see in Canada, and we still have to see it in the US, is that it's not, and that the economy slowly will recede based on these interest rates. So I would take the middle path here and say these rates are perhaps unsustainable. And we did see the bond market actually rebounding after we've hit 5%. But in the end, yes, there's a possibility that when we do actually see lower interest rates, we're not going to settle back to what we had during the prior decade.
You have another chart for us showing the odds that the market is assigning to rate hikes in October. And essentially, the market, very few people think that there'll be a hike today.
Yeah, and it's probably lower. That I did that chart last Friday. It's probably lower as we speak. And yes, I think the final detail we needed for that decision was last week inflation report, and it was a relief that for the first time in a couple of months we did see broad-based disinflationary pressure, and that's despite the fact that energy actually jumped in September. So after that report, we have the combination of slower economic activity in the near term, an expectation of even slower activity in the fourth quarter, and a first sign that inflation has been disinflationary. And that's why we don't expect a rate hike today. And we also don't expect at Manulife a rate hike in December.
We've only about a minute and a half. I suppose this is a fundamental mind shift for consumers, isn't it, after more than a decade of near zero interest rates? The past year has been traumatic in some ways.
Oh, definitely. I personally never seen that kind of interest rates in my life, and it's still hard to adjust. And it's also a mind shifting for, I think, consumers to maybe plan ahead, thinking about the fact that interest costs are a factor into their consumption decision in the next year. And I would add to that, maybe over the next couple of months, that the job market will get a little looser, and that people will also have to plan on the fact that maybe for some industries there will be fewer hours worked. It's going to be harder to switch job, and that will also affect consumption decisions.